You were told the big banks learned their lesson, that the government stepped in, that the system was fixed, that 2008 was a once-in-a-generation disaster that could never happen again. So let me ask you something. If the system is so safe, why did three major U.S. banks collapse in a single month in 2023? Why are commercial real estate loans quietly rotting on bank balance sheets right now? Why is the Federal Reserve running a secret emergency lending program that most people have never even heard of? And most importantly, why does the FDIC, the agency that supposedly guarantees your deposits, only have enough money to cover about 1.2% of all insured deposits in America? Stay with me, because what I'm about to show you is not a conspiracy theory. It's arithmetic, and the arithmetic is terrifying. Here's what most people miss. When you deposit money in a bank, any bank, including a Big Four bank like JP Morgan, Bank of America, Wells Fargo, or Citigroup, that money is not sitting in a vault with your name on it. The moment you hand it over, it legally becomes the bank's money. You become an unsecured creditor. You are, in plain English, loaning your money to the bank and hoping they give it back. Most of the time they do, but not always. Right now, investors across America are watching something deeply confusing unfold. Interest rates went from near zero to over 5% in the fastest hiking cycle in 40 years. That should be good for banks, right? Higher rates mean more profit on loans. The narrative made sense. But that's only the surface explanation. The real mechanism is far more dangerous, and it's already in motion. Here's how it actually works. Step 1. During the era of zero interest rates, roughly 2010 to 2022, banks loaded up on long-duration assets, treasury bonds, mortgage-backed securities, commercial real estate loans, assets that pay a fixed rate for 10, 20, 30 years. Step 2. The Fed raises rates at a historic pace. Suddenly, those long-duration assets are worth dramatically less on the open market. A bond paying 1.5% is nearly worthless when new bonds pay 5%. This is called unrealized losses, and as of late 2023, U.S. banks were sitting on over $500 billion of them. Step 3. Depositors notice. They move their money to money market funds paying 5%. Bank deposits shrink. Liquidity tightens. Step 4. One crack appears. Word spreads. A bank run begins. Silicon Valley Bank, the 16th largest bank in America, went from solvent to seized in 48 hours. And this is where everything changes. Because SVB wasn't some reckless fringe institution. It was a federally regulated, audited, highly regarded bank. And it failed not because of fraud, but because of the exact same bond math that sits quietly on the books of nearly every major financial institution in America right now. History shows this pattern again and again. In 1929, the American public believed the banking system was unshakable. Then 9,000 banks failed in 3 years. Entire communities lost their savings overnight. Not because they were reckless, but because they trusted the system. In 1980, the savings and loan crisis unfolded in slow motion. Interest rates spiked under Volcker. S&Ls were caught holding long-term fixed mortgages while their cost of funding exploded. Over 1,000 institutions failed. The government bailout cost taxpayers $130 billion, an almost incomprehensible number at the time. In 2008, the world watched in real time as Bear Stearns, Washington Mutual, and Lehman Brothers collapsed. These weren't small community banks. Lehman had over $600 billion in assets, and yet it was gone in a weekend. And in 2023, Silicon Valley Bank, Signature Bank, and First Republic all failed within weeks of each other. The FDIC had to backstop hundreds of billions in deposits that exceeded the insured limit. Each time the public was told, "This is contained. This is an isolated incident. Your money is safe." Each time it wasn't. But why does this time feel different? And it does feel different. Even seasoned macro investors will tell you, the structural setup today is unlike anything we've seen in the modern era. Here's what makes this moment genuinely dangerous. The U.S. national debt has crossed $34 trillion. Interest payments on that debt are now running at over $1 trillion per year, more than the entire defense budget. The government is borrowing money just to pay the interest on the money it already borrowed. This is not sustainable. This is a debt spiral. Meanwhile, commercial real estate, the loans sitting on bank balance sheets across America, is in free fall. Office vacancy rates in major U.S. cities are at historic highs. Remote work didn't reverse. Those loans are coming due. And they were written at 3% when replacement financing now costs 7 or 8%. The math simply doesn't work. Here's what makes this moment different from 2008. In 2008, the Fed had room to cut rates from 5% all the way to zero. They had ammunition. They fired it all. Today, if a banking crisis erupts, the Fed faces an impossible choice: cut rates to save the banks and risk reigniting inflation that's already burned working families for 3 years. Or hold rates high and watch the losses on bank balance sheets compound. There is no clean exit. That's the trap. And the people who understand this best, central banks around the world, are buying gold at the fastest pace since 1967. China, Russia, India, Poland, Turkey. They are quietly, systematically moving reserves out of dollar-denominated assets and into physical gold. That is not a coincidence. That is a signal. So what happens next? Let's walk through the likely phases. Phase 1 is the slow bleed. This is where we are right now. Unrealized losses stay on bank books. Regional banks quietly restrict lending. Credit tightens. Small businesses struggle to borrow. The economy softens without a dramatic visible trigger. The mainstream media calls it a soft landing, but underneath the surface, the pressure is building. Phase 2 is the trigger event. It could be a commercial real estate default that cascades. It could be a regional bank that can't roll over its funding. It could be a geopolitical shock, oil, Taiwan, the Middle East, that rattles global confidence overnight. We don't know the exact spark, but the kindling is already there. Phase 3 is the response. The Fed cuts rates. The government announces emergency measures. The FDIC backstops deposits beyond the $250,000 limit. Again. And the dollar, already under pressure, weakens further. Hard assets, gold, silver, real productive resources, reprice dramatically higher in dollar terms. Smart money is not waiting for Phase 3 to arrive. Smart money is already positioned. So what are the specific signals you should be watching right now? First, watch the BTFP, the Bank Term Funding Program. This was the Fed's emergency lending facility launched after SVB collapsed. At its peak, banks were borrowing nearly $170 billion from it. Watch what happens to bank funding stress as this program winds down. Second, watch regional bank stocks. The KRE, the Regional Banking ETF, is a real-time stress gauge for the part of the banking system that doesn't have the implicit government backstop of the Big Four. When regional banks start declining in unison, it's an early warning signal. Third, watch gold and silver. Central banks don't buy gold as a speculative trade. They buy it as insurance against the system they help run. Gold breaking and holding above $2,000 per ounce and pushing toward $3,000 is the market pricing in systemic risk. Silver, which also has massive industrial demand in the energy transition, has historically followed gold with amplified moves. Fourth, watch the credit default swap market, basically the insurance market on bank debt. When the cost of insuring against a major bank defaulting starts rising quietly, that's sophisticated money hedging in real time. You won't hear about it on financial television, but you can find it if you look. Here's where we land. The Big Four banks are not about to collapse tomorrow. Let's be precise about that. They have government backstops, global diversification, and political protection that smaller banks don't. But here's the honest question you need to sit with. In a system where your deposit is legally the bank's money, where the FDIC insurance fund covers barely 1 cent of every dollar it theoretically protects, where banks are sitting on hundreds of billions in unrealized losses, where the government is drowning in debt and the Fed is out of easy options, how much of your wealth should be entirely inside that system? History doesn't repeat, but it rhymes with an almost cruel precision. The people who protected their wealth across the 1930s banking collapses, the 1970s inflation crisis, the 2008 financial meltdown, they weren't geniuses. They simply understood one thing. When the system is under structural stress, having some of your wealth outside the system is not paranoia, it's prudence. The signs are visible. The mechanisms are in motion. The question isn't whether this is happening. The question is whether you're paying attention before the rest of the crowd wakes up. Because by the time this becomes the headline story, it will already be too late to act on it. If you want more deep market analysis like this, subscribe and stay close to the channel. This is exactly the kind of content we dig into every week. The signals, the mechanisms, and the historical patterns that give you a real edge before the mainstream catches on.